This is an episode we were hoping not to have to record, and that's because mortgage rates are going in the wrong direction, and it really boils down to a couple of different factors. The first one being Trump, followed by inflation, the Fed, jobs, economic growth, as well as the stock market. So in today's episode, that's exactly what we're going to dive into.
Jeb, I'm going to throw it into one word. All of those things that you just talked about are uncertainty. The markets are uncertain. That leads to fear. Fear leads to defensiveness, and defensiveness in this situation, sometimes when there's fear or uncertainty, when there's, a global war breaks out over the weekend, you see a flight to quality, it helps interest rates. In this instance, because a lot of it is fears of overspending by the government, fears of inflation, fears that inflation may not be as much under control as originally thought, that is leading to defensive positioning. So we're going to go through all these things, how it is impacting the market, and what you're going to have to see before that reverses, but most importantly, why that's not likely to happen in the next 60 to 90 days.
Well, let's start with the one that's really on a lot of people's minds at the moment, and that is, the result of the election. Trump was elected as our 47th president, which will take office in January. With that, it looks at the moment that we're going to have the red wave, that he's also going to have Congress, both the House and the Senate, on board. So the expectation, or the market's expectation at the moment, somebody's expectation, clearly, because of rates moving higher, the bond market moving higher, is that this is going to result in inflation, that his policies are going to drive inflation higher. So let's start there, because we talked a little bit about it in our episode where we talked about Trump, but let's kind of boil it down more so to mortgage rates than we were talking about just policies in general.
Absolutely. So it's tax cuts and tariffs. People say, well, what about why are we talking about tax cuts? He already did that in 2016. The way it was done, they expire after 10 years. So whoever was elected was going to have to deal with that. And if it went the other direction, they were likely to increase. So the tax rates would likely increase from where they're at. We are most likely to see some type of extension, although not verbatim, of the 2017 tax code, something very similar to that. So less government revenue than otherwise. So that means more government borrowing, which is the Treasury borrowing competes against mortgage bonds. So when there's more supply out there, there's a fixed amount of demand, you have to go to higher yields to get it. That's the thought right there. The second piece of it is tariffs, Jeb, and that tariffs are going to increase prices on all of the imported goods that we bring in, and that will lead to an increased round of inflation. And it certainly could. If you put his most outrageous campaign proposal was 60% tariffs on everything from China. If you did that, you would have a 60% increase, in theory, in the cost of goods, whether it all got passed on to consumers, and it would happen all at once. But if they didn't go up the next year, remember, again, inflation is a rate. It's a rate of change. So you would have really high inflation on those items in the first year, and then it would level off. So from that perspective, those things don't directly go into bonds. But because the market doesn't know exactly how this is going to play out, because the market seems to forget that we had 4 years of this, same proposals, tried to do the same things, and the fact that two things, there's campaign promises, and then there's reality, and there's also what Trump says and what Trump actually wants. His style of negotiating is to set the bar so far to one side, he has a lot of room to compromise and still get what he wants. So tariffs shouldn't be nearly as bad as expected. Tax rates, probably not quite as Trump friendly as what we had in 2016. So they're there, but we need time. We need 30, 60, 90 days for him to get clear on what he's proposing, to get his cabinet in place, and then to see what is likely to get through. And one last thing, Jeb, you had mentioned this red wave. Red wave, yes, they are likely to end up with all three parts of the government, but very narrow margins in the Congress and Senate. So you can't come up with really radical legislation, because if you have any Republicans defect, you just don't have the margins to push through crazy stuff.
Yeah, and we know from the last time that the tax cuts were passed that that there's going to be some negotiation in what's proposed this time, or what's actually passes this time, because just because you have both doesn't mean you're going to be able to get away with anything. And there were high cost states like California, New York, where real estate, where people actually lost money with tax cuts. I mean, we pay higher taxes with tax cuts, which seems crazy. How does that happen? Well, it's because of some of the changes in what was you were able to write off versus not, and so on and so forth. So again, uncertainty being the key word in that, but you said something there. Tariffs, the idea is that it leads to inflation. So let's talk about inflation. Inflation has been coming down for the better part of 2 years. I think our peak was at 9.1% at one point on the headline, and I think core, I don't know, over 7 at one point. But either way, inflation is coming down. Minus shelter, if we do an average, we're sitting somewhere around what the Fed wants to see, 2% inflation. But we both know at the same time, the Fed has admitted that inflation, they know inflation's coming down. It's getting closer to their number, but it's not just about inflation anymore. It's also about jobs and the economy and all of that. But let's start first with inflation because it's an important piece that is keeping rates higher and really the shelter component.
Yeah. So we're at 3.3% year over year on core CPI. They prefer PCE. PCE is lower. PCE has been consistently in the high threes or in the high twos. So approaching what they want, but not there. And we've seen a little bit of this stall out over the last couple, 2-3 months where we haven't seen additional progress. Part of that is that the figures that fell off from last year were relatively good. If we say a 0.2, the way they do is they aggregate that across the 12 months. So it's 0.2 times 12. Well, that's 2.4. So it's good, but it's not great. It's not where they want to see it. So we're not seeing hot inflation. We're not seeing this terrible inflation. Consumers, you likely watching this, are still feeling, hey, prices are too high, but that's different than the current rate of inflation, which is just above where they want to see it. And really, if we wanted prices to moderate, we would need a period of disinflation, a couple of years of 1.5% inflation before things started feeling a little bit more normal to your pocketbook. So the reality is, as you said, it is primarily shelter costs. And if we take away shelter costs, we're well below 2%. So you're probably watching home saying, hey, idiot, I'm watching the educated home buyer. We are talking about homes and shelter and costs, whether I rent or whether I own. So you can't take it out. But what we can say is we watched this distort the inflation measures that the Fed uses on the way up, because it lagged. It was showing shelter costs were not rapidly increasing when we all knew that they were. And then it all came all of a sudden at once, and the Fed had to act very aggressively. We should, at some point, see these moderating because the actual real-time numbers versus owner's equivalent rent, the type of things that they get factored into PCE and CPI, those are lagging and a little more slowly catching up. So that tells us that we should continue to see moderation towards 2% that the Fed wants. But because we're not getting there rapidly, we're not seeing a market reaction. The market is hesitant, going, hey, maybe we're not sure that we're going to get where we thought we were.
No, and so with that, right, so inflation is staying essentially higher for longer, which is, again, pushing up rates, and rates are, in theory, staying higher for longer. That's the idea here, that we thought rates were going to come down, and we did see them come down. But then all of a sudden, we saw some changes in, how the market was looking at things, just in general. We still had, economic data reporting better than expected. Occasionally, it wasn't just this downward trend every single month. It was, hey, we got a couple of down months, and then all of a sudden we get this pop, and it's like, what's going on here? Well, all of a sudden the bond market reacts, and you've got, bonds and mortgage-backed securities and everything moving the other direction. Rates are going back up, and people are going, what the hell? I was waiting. I thought rates were going to continue down, and now all of a sudden they've jumped 1%. So let's talk about how the Fed looks at inflation and looks at economic data, because they're two separate things. Inflation and economic data aren't the same thing. We know that the Fed's dual mandate is price stability while maintaining basically maximum employment to some degree. Employment has remained stable, and we're going to talk about the economic data, but let's talk about how the Fed looks at these two things, jobs, inflation, and then makes decisions, and why those things are likely going to keep rates probably higher for the short term.
One of the biggest questions that we get on the live show is, why is the Fed cutting when inflation is still too high? We just acknowledged here inflation is above their target, hopefully moderating in the right direction towards 2, but they're cutting. Why are they cutting? Because when they're looking at the policy rate, whether it's restrictive or accommodative or neutral, we're largely looking at real interest rates. So meaning, where is inflation? Where is the Fed funds rate? Well, we were up at 5.25 with inflation at about 2.6%. So call that a 2.6 real Fed funds rate, and that's restrictive. So they can come down to 2 to 1.5 fairly easily. So the hope is that inflation continues to moderate and goes down towards 2%. So they had room to cut. And if inflation continues to recede, they would have more room to cut. So prior to and just after the big 50 basis point cut in September, the futures market had priced in at the end of 2025, at the end of next year, a 2.9% federal funds rate. And as of this morning, and again, this isn't the gospel. This is where they're placing their bets. They're wagering on a 3.9 federal funds rate. That's a big difference. It's a 1% difference in the Fed funds rate. And we've talked about this. Fed funds does not directly impact mortgage rates, but there's a correlation. They move in similar directions. When Fed funds is coming down, interest rates should be coming down, and mortgage rates should lead that. They should, just like they did prior to that 50 basis point Fed cut, they will lead on the way down. Right now, markets of all stripes, whether they're buying treasuries, whether it's the Fed funds futures, whether it's mortgage-backed securities, no one is convinced that we have this decisive break to the downside where we're going to see lower interest rates.
No, and I mean, the Fed even came out yesterday, or Powell came out yesterday and basically said that there's no hurry. There's no hurry to cut rates, and it's because of everything that you just said. We're getting some positive signs on one side, some, negative, if you will, signs on the other. Negative, depending on how you look at it. A strong economy is a good thing. It's not a good thing if you're trying to buy a house and trying to get lower rates and trying to do things that, put you in a better position financially, unless you're in the stock market, which we're going to talk about how the stock market impacts this whole thing. So go ahead, Josh. I know you're looking at.
Well, what I was going to say is you said the important part of the quote from him yesterday, but the full quote was, "We're going to cut rates, but we're not in a hurry. We're not feeling a rush. We're not feeling pressure to do it." So they haven't changed their mind. They haven't come back and said, "Hey, maybe we were wrong. We're not going to cut." They're saying they're going to cut. We're not in a hurry to do it. And as of today, in terms of the December meeting, 60% odds that they cut again in December, which when they cut last Thursday, there were 80% odds that we would see another cut in December. So again, uncertainty. Is the market saying, no, they're not going to? They're going, no, we're just not nearly as sure as we were a week ago.
And nor are we. So, Josh, let's talk about jobs. Jobs are probably the biggest thing keeping the market from that recessionary tail that everybody's been talking about for the better part of a year and a half, 2 years. I mean, we've been talking about a recession for a very long time, this idea that a recession was coming because inflation was slowing, because the economy was slowing, because job numbers were slowing. And then all of a sudden, we get stability somewhat in the job market. And yesterday, jobless claims came in at the lowest level we've seen since May, which again is a positive sign for the job market. The Fed is probably paying more attention to jobs than they are inflation at the moment, because they've acknowledged that inflation is coming down. In fact, Fed Chair Powell mentioned that several times yesterday in the press conference, that we know inflation is coming down. It's less of a concern, is basically what he's saying. But jobs are important because of why, Josh? It leads back to that inflation potential, which again,
if there aren't enough people needing work, if you need to hire someone, you got to go poach them from someone else. Generally, people don't want to leave their current jobs without an incentive. The general incentive is higher wages, which is inflationary. The more people make, the more they spend, it increases the prices of everything. So we're really looking on all sides, this Goldilocks sort of, you want inflation a little bit, but not too much. You want low unemployment, but not too low. So as we were looking, I always look back. I started doing this in the mid to late 90s, and all the way through, say, 2005, 2006, the feeling was that 5% unemployment was full employment. There were hardcore unemployables, people that couldn't hold a job, people that didn't want a job, whatever that is, but felt that it was about 5%. Well, we've been below that, way below that, for 4 or 5 years now. And for a period during COVID, there was definitely pressures on wages. So the Fed looks at the job openings and labor turnover survey. So that tells them that has steadily been coming down. So there are less job openings, so less employers looking for jobs. And we've seen unemployment tick up just a little bit. So less people looking for jobs, less companies looking for people to hire. So we haven't seen this wage-based inflation. But what the markets are looking for is, if we could get up to 4.5, 4.7, 4.9, 5.1 on the unemployment rate. Still fairly solid. Most people that want a job have a job, but you really have no worries of wage-based inflation at that point. So we need to just keep looking at the JOLTS that comes out once a month. We need to keep looking at the non-farm payrolls, which that's been problematic data for over a year or 2 years now, where we see these really hot numbers that don't seem to match up. And then 2-3 months later, we get big revisions and you go, yeah, that's kind of what we thought what it was expected to look like. And last month, Jeb, we got a crazy low number and it was dismissed. We had 12,000 jobs created. I think 128,000 was what they were looking for. They go, oh, it was hurricanes and other stuff. Don't worry about it. So uncertainty.
Yeah, and I think it's important to pay attention, not so much to the monthly numbers, guys. I mean, this is where it gets really confusing because we're constantly reporting or commenting on the monthly numbers and giving you data based on the monthly numbers. But what you more so have to pay attention to is the trend, right? What is the trend over several months? Is it continuing down or has the trend changed entirely and now the market's moving the other direction? And I think it's really important to note the trend is still intact. It's just a volatile market. There's a lot of uncertainty, as we mentioned several times. And, it translates into these wild swings in mortgage rates. And that's why it's really, really important. Like when you're ready to lock a rate, that you lock the rate. I mean, I can't tell you how many people are commenting on videos saying, hey, listen, my loan officer told me that we should wait. We should wait because there's data tomorrow and we shouldn't lock. No, this is not the market for playing games, especially when, the most recent data is showing things opposite of what you would actually want to see lower rates. The reality is, in order to see lower rates, you need a slowing economy. And as much as I and Josh and whatever think that we have this slowing economy overall, the data isn't showing that. And you got to do what the data is doing, not make up what you want it to be. And so with that, Josh, let's talk about economic growth, economic data, whatever. Retail sales. One of the big things that people watch, market mover, came in way higher than expected. And we're headed into the holiday season, right? And so, more spending, stronger economy, these are all things that don't work for lower rates.
That retail sales report is sort of a microcosm of the reports we've been getting for the last 6 months. You see the headline and the market goes, uh-oh. And you see a knee-jerk reaction. And as the morning goes on, the data is not just the headline. What we as consumers see or is in the Wall Street Journals, in the LA Times, whatever you read, you see a headline and you go, oh, crap, it was expected at 0.4 and it came in at 0.8. That was double. Well, then the nerds go to work on the whole report and start looking at it and they go, oh, it was sort of the volatile components and the underlying things that we really look for strength in the economy. If the consumer were really spending more money, they were right in line with where they were expected to be, which is not to say weak. So again, on the mortgage side, when we're sitting here hoping for interest rates to go lower, you're like a vulture. You need someone to die. You need things to go bad. So you feel bad about that we're going, oh crap, that stupid report came in good. You want consumers to feel flush. You want them to be out spending. But at the same time, that does lead to higher interest rates. So if we had rates at 5%, we'd all kind of be probably going, yeah, we don't love this. But if everyone's got a job and making good money and feels free to go spend and go on vacation, we're kind of okay with that. It's just the data, the underlying data in all of these reports tells a different story than the headline. And consumers, and to some degree, the markets are trading off of the headline. So from that perspective, we get, the Atlanta Fed does their GDP now, and they're pushing up, 2.7, 2.8 is their projection for the fourth quarter. The blue chip estimate that they also report in there is under 2%. Most of the people that I follow, whether it's David Rosenberg, Peter Bookvar, all of these people, they look at it and they're like, this just feels a lot like a 1.7, 1.8 economy. And let's look at the important part there. That's a growing economy. That's not a recession. That's not terrible, but it's a slow growth kind of, hey, things aren't bad, but they're not good. So we have the official government figures keep coming out and telling us they're B grade. And we have the analysts saying, parsing out all the data, it looks more like C grade, maybe even C minus. So any way you cut it, we're not getting an economy rolling over. And be careful, like for those of you who say, I just need rates to get back to 4%. If we were to go from the doorstep of 7 today down to 4, a 3% cut, it's a massively different economy. And you're going to feel differently about your prospects of your future and what you're wanting, willing, and able to do. So we're like the markets. We also want sort of Goldilocks. We would like lower rate, but a strong economy where people feel comfortable making economic decisions.
Yeah, I want to eat pizza and get lean at the same time, Josh. I want it all.
You scared me. I didn't know where you were going with the second part of that.
I mean, and the cake. I want it all. But let's talk. You mentioned this earlier, but let's talk about the wealth effect. What is the wealth effect? The stock market, right? How people feel they're doing financially. And what happens is when they see the stock market doing well, people that have money in the stock market, maybe they have money in Bitcoin, they have money in gold, whatever it is, and these things are going up, reaching all-time highs, people feel better about themselves. They feel better about the economy, consumer confidence. All of these things fall in line there. So you mentioned earlier, when this happens, stock market does really well, that competes against bonds. What happens? People pull money out of bonds and they put it in the stock market. Well, when they pull money out of bonds, guess what? Rates go higher. And so we're kind of, throwing it back to the Trump piece of this puzzle where we started the episode and said, Trump is a big proponent of strong market, right? He wants lower rates, but he also wants a really strong economy. Hard to get both in most cases. But if he gets this strong economy, there's less of a chance that we see rates move substantially lower at the same time. And so you've got this uncertainty, Josh. And so, when you hear me say that, what are your thoughts?
Well, we talk about mixed messages, right? So the people like to say on the show, this economy is turning over, savings rate are at a 6-year low. Well, there's a strong correlation between how the markets are performing to the savings rate. When someone's stocks go up 12% in the course of a month, they're less likely to feel the need to save. Let's just say, a 40-year-old and they've got 100,000 in their 401k. If it goes up 10%, let's go say 5% in a month. That's a really good month, but we've had several 5% months over the last 12 to 24 months. They made $5,000. Do they care that they didn't put $400 into their savings account? They do, but they care less. So it has been proven that when the market is doing really well, when people have a year-over-year gain of 20+% in their invested assets, they're less worried about saving elsewhere. When the market's flat and it's not giving you these big returns, then people are much more prone to save. Same thing with spending. If my 401k, say I'm 60 and I've got $2 million in my 401k and it went up $400,000 this year, I might just go, guys, the family's going to Hawaii for Christmas and it's on grandpa, It's on dad, $50,000. I don't care because the market gave me a $400,000 gift. That is a real thing. It may not be your thing, especially if you're younger. A lot of you guys listening to us are first-time home buyers. You're 28, you're 32, and you don't have those assets built up. But that is the reality when you get to the far end of that window and all those years of saving, investing, and growing. When you get a hot market like we've had in the last year, it changes consumer behavior in terms of what they're willing to spend and how much they feel they need to save.
No, and I think it's important to mention, guys, this isn't about telling you, that you shouldn't do something or you should do something. It's about knowing where the market is and just being able to make decisions for yourself. Like if you know that all your money is going to be tied up into a property and that you have no savings and there's a chance that the market moves sideways to down, you got to pay attention. You got to build this into your plan, if you will. And most people go into it with no plan at all. And I think the important thing, the reason for the podcast in general is to help you guys understand how markets work, housing, mortgage, everything. And then you can plan accordingly around that, right? But you have to have that plan and not just shoot from the hip with everything. And believe it or not, Josh and I actually aren't full-time podcasters or content creators. We actually sell real estate and do loans. So if you're in the market to buy a house, you need financing, you have questions about any of that, use us as a resource. We're here. That's why we do the show, is to educate, but we want to provide value to you guys. And you can get in touch with us using that link in the description of this video. So with that, Josh, anything you want to leave with our audience today in talking about rates and the direction that they're headed?
Just don't expect big changes over the next 60 to 90 days. We're going to see increased volatility, increased uncertainty until we get somewhere, some point in the first quarter. You get to Inauguration Day, we get some cabinet members confirmed, we get some policy proposals out there, then the market will have something to actually deal with on the politics side of it. More importantly, we get 90 days down the line, we're going to have 3 more jobs reports, 3 more JOLTS reports, 3 more PCE and CPI reports, and we'll have some additional certainty there. If you remember last year, February, March, April, we had an acceleration in inflation. We don't expect that to happen this year, and if it doesn't, as those months fall off, then the year-over-year figures will improve. Now, the Fed's smart. They can look ahead at this. They don't look and go, oh, because we have 3 really high months falling off, inflation's coming down. They do look at the 90-day, the 180-day run on that. But markets aren't as smart as the Fed, and you will see some improvement there. So from my perspective, I don't want to speak for you, Jeb. I do think there are better days ahead, but pretty much for the last 2.5 years, it's just more volatile and taking longer than either of us expected.
No, and I agree. There are better days ahead. You got to do what the market's doing and not what you think it's going to do. So when you're making decisions on locking rates, on buying homes, focus on the now. Don't focus on what you think it's going to be down the road to make a decision in whether or not it makes sense, right? Control the controllables. But until next time, guys, make sure you buy right, you borrow smart, build wealth. Adios.
Amigos.